I would now like to focus on the liquidity and financial market conditions, about which there is a lot of interest in the financial markets and also elsewhere. After remaining in surplus during April-August 2023, system-level liquidity turned into deficit from September after a gap of 4.5 years. Adjusted for government cash balances, potential liquidity in the banking system is still in surplus, and that may surprise you. But adjusting for government cash balance, potential liquidity in the system is still in surplus. During December-January, the Reserve Bank proactively injected liquidity through both the main and the fine-tuning repo operations to ease liquidity tightness in the system. With government spending picking up and augmenting system-level liquidity, I must mention that in the recent, particularly towards in the second fortnight of January, government expenditure was sustained. But I think there has been a significant pickup from the second fortnight of January, and also we are witnessing the same in February. And so with government spending picking up and augmenting system level liquidity, the Reserve Bank undertook 6 fine-tuning variable rate reverse repo auctions, that is VRRR auctions, during February 2 to February 7, 2024 to absorb surplus liquidity. Financial market segments have adjusted to the evolving liquidity conditions in varying degrees. While the short-term rates have fluctuated, long-term rates have remained relatively stable, reflecting better anchoring of inflation expectations as indicated in the softening of term spread in the government securities market. In the credit market, however, monetary transmission remains incomplete. Let me reiterate, and this is very important, let me reiterate that our policy stance is in terms of interest rate, which is the principal tool of monetary policy in the current framework. Our stance of withdrawal of accommodation should be seen in the context of incomplete transmission and inflation ruling above the target of 4%, and our efforts to bring it back to the target on a durable basis. So far as liquidity conditions are concerned, these are being driven by exogenous factors which are likely to correct in the foreseeable future, aided by our market operations. On our part, the Reserve Bank remains nimble and flexible in its liquidity management through two-way main and fine-tuning operations in both repo and reverse repo. So you would have noticed we have done two-way, market interventions, both repo and now reverse repo. And we have been very nimble even during one particular day, like yesterday and day before. On a single day, we conducted 2 VRRR auctions on a single day. That was seen yesterday and day before, and that goes to show that we are nimble and swift in our response to the evolving liquidity conditions. Now, I would like to emphatically state here that we will deploy an appropriate mix of instruments to modulate both frictional and durable liquidity so as to ensure that money market interest rates evolve in an orderly manner and financial stability is maintained. The reversal of liquidity facilities under both SDF and MSF, even during weekends, which we announced in the last, that is in December policy statement, has actually facilitated better funds management by the banks. As of February 7, 2024, the Indian rupee has remained stable compared to both its emerging market peers and even a few advanced economies. In terms of coefficient of variation, the Indian rupee exhibited the lowest volatility in 2023-24 as per the data available between April to January of the current financial year. Now this I am saying compared to the corresponding period in the previous 3 years. Let me reiterate that the exchange rate of the Indian rupee is market determined. Its relative stability in the recent period, despite a stronger US dollar and elevated US Treasury yields, reflects the strength and stability of the Indian economy, its sound macroeconomic fundamentals, financial stability, and improvements in India's external position, particularly the significant moderation in current account deficit, comfortable foreign exchange reserves, and return of capital flows. Now, the confluence of all these factors put together have ensured that the Indian rupee, the exchange rate of the Indian rupee, has remained fairly stable over the last 1 year or so.